welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, welcome to the Essential Tax Podcast. I'm very excited today. I've spent the last 3 episodes talking to different guests about being healthy during tax season. Today we get back to actual tax topics. Just as a little background for everybody, the Wolf Group, we're part of the Nexia International Network, and occasionally we bring in some of our sister firms from the network that are located in foreign countries, and we talk about U.S. cross-border tax issues with those folks. Today, I'm very honored to have Paolo and Dirk from our sister firm in Italy. Paolo, Dirk, if you would just take 2 seconds and maybe just tell our audience a little bit about your education, background, all that good stuff.
Morning, Mishkin. Good morning to everybody. So my name is Dirk, and I'm a tax partner in HAGER Partners, which is a member firm of Nexia, as you said. And we are based in Milan. We have 2 other offices in Italy, and we are dealing with tax issues. We normally provide a complete tax support, basically for individuals and multinational groups who have their subsidiaries here in Italy. So we are, I would say, used to do cross-border tax activities and sometimes clearly also for individuals.
Awesome. Paolo?
Hi, good morning, everybody. I'm Paolo. I'm working at HAGER Partners with Dirk for 20 years. And yes, we're providing to clients tax consultancy. I work a lot also on tax litigation services. And that's, and Dirk has said everything important.
Okay, fantastic. Well, if you haven't guessed it already, today's episode is about the U.S.-Italy cross-border tax issues. And I can tell you that from where I sit on the bus, Italy is the hot place to be. A lot of my U.S. clients are like, how do I get to Italy? What are the tax rules for Italy? How do I operate when I get there? I think they just want to be there. They want to enjoy the food. They want to enjoy the culture. They want to enjoy the wine. But there are some practical realities to being in Italy. So let's walk through that. Let's go through some basics about the Italian tax system. And kind of like building blocks are working out, we'll build up to, some heavy lifting here at the end. So first question I have, and I always have this for every single country that a client of mine is looking to go into. Talk to me about what are the rules for becoming a tax resident in Italy? Is it just as simple as I spend 6 months in a day in Italy and then I become a tax resident? Is there something more to it? In the United States, we're super complicated. We like to look at 3 years and then we count days all weird. How does it work in Italy? Tell us about how you become a tax resident.
Yes. It's not so complicated anyway. Some rules exist also in Italy. Essentially, an individual to be qualified as an Italian tax resident has to meet one of 4 alternative conditions. Substantially, the first one is the residence in Italy, residence from a civic point of view, so meaning the habitual abode. So if the individual has his habitual abode in Italy, or domicile meaning the center of individual's personal and familiar relations. In this case, it's important to highlight that due to a recent change in the tax law, the business interest is not relevant to what counts is our personal and familiar relations. So differently from double taxabilities, for example. The third condition that could be met is physical presence. So just the physical presence, staying and being in Italy for 183 days out of in the year. And the fourth one is a formal condition, is the registration in the civil registry of resident population. So it's enough to meet one of the 4 alternative conditions to be considered as an Italian tax resident. To Other important aspects to be considered is connected to citizenship, which is not relevant. So these 4 conditions are the same for Italian nationals or non-Italian nationals, something which is on basis of my knowledge, something different from the US, for example.
Yeah.
And another essential element is the fact that these conditions must be met or not for a greater part of the tax year. So if only one of the conditions is met for the greater part of the tax year, then the individual is considered as an Italian tax resident for all the tax year. Differently, on the contrary, you need not to meet all the conditions for the greater period of the part of the year in order to not be considered an Italian tax resident. So substantially, if you move to Italy in the first half of the year, then you are considered as tax resident for all the year. And
Okay.
if you want to leave Italy in order to be considered as a non-tax resident, you have to leave Italy in the first half of the tax year, substantially.
Okay, and that was my second question: is how do you break the tax residency? So in your basically what I heard you say is that to become a tax resident, there's some objective tests, there's some subjective tests, and then to break the tax residency, you just need to make sure you leave in the first part of the year. Is there anything else to breaking the tax residency that we need to be aware
No,
of?
because the conditions are those 4 conditions and are
Okay.
the same to be analyzed in order to be considered as a tax resident when you move to Italy, and are the same that you have to analyze not to be met in order to break the tax residence. So the analysis is substantially the same, but obviously considered on the 2 different sides when you arrived, and you have to meet one of them for the greater part of the year. When you leave, to be sure that you don't have any other connection to Italy in terms of tax resident, you have to not to meet all the 4, because they are alternatives. So all the 4 for the greater part. So when you arrive, just one is enough to be considered as a tax resident. When you leave, in case all must not be met in order to not be to stop being an Italian tax resident.
And I assume you need to file a tax return there at the beginning, throughout, and then there at the end, just to make sure it all is in full compliance. Or is there, once you break tax residency for that year, do you not file again? Or
no, in the sense that the tax return filing is connected to the fact that you are a resident. So, for example, you become a tax resident in 2025, then in 2026 you have to file the tax return connected to 2025 because you are a tax resident, or if you are not tax resident because you have some Italian source income, substantially. When you leave in the year when you leave, for example, if you live in 2025, if you are not tax resident in 2025 and you don't have any Italian source income in 2025, then you don't have to file a tax return or some return to communicate that you are no more an Italian resident. You have to file a tax return when you have income to declare and income to tax, which is not subject to withholdings, obviously.
Okay, and Italy operates, so the US operates on a calendar year, so January 1 to December 31. There's some countries in Europe that operate on a fiscal year, like the UK, for example. Is Italy on a calendar year or a fiscal year?
Yes, it's the same. It's calendar year, taking to individuals. For companies and so on, it's different, but with regard to individuals, it's the same. So 1st of January, end of December is easier in a certain way, not in UK, April, something like this. No, we have January, December, like in the US.
Right. And then the Italian tax return is due when?
Well, the following year. So you have to file the tax return within the 31st of October of the following year. So thinking to 2025, you have time till the end of October 2026 to file the tax return. Then, as for payments, is a little different because during the year you have to make 2 advance payments, one in June and one within the end of November. And
Okay.
usually it is calculated on the basis of historical figures, so the figures of the previous year.
Okay.
And then the balance has to be paid the following year. So substantially during the year you have 2 advance payments, and then the following year you have to pay the balance and to file the tax return. The balance within June and the tax return within October, substantially.
Okay, I mean, it sounds a lot like the U.S. safe harbor estimated tax payment rules, and it's kind of almost similar to how we do the U.S. tax returns on extension. There's the tax is due by April 15th, but you can extend it to October 15th. Okay, let's switch gears for a second because we just spent a little bit of time there talking about tax residency and the basics for income tax filing. Let's talk about a more advanced topic here. Let's talk about inheritance taxes. Does Italy have an inheritance tax? I'm looking at you, Dirk.
Yeah, for sure. We have it. But let me say, I think it's really convenient because basically, if you speak about tax or inheritance tax, everyone is afraid of. But we have to say we have still a nice regime over the years. The first difference to make is if you are fiscally resident or not. So if you become fiscally resident in Italy, you have to pay inheritance tax for your worldwide assets. So everywhere they are located, investments, real estate, whatever, you have to pay for that in Italy. Otherwise, if you are fiscally non-resident, for example, a US citizen who has just a nice house on Capri, then he has just to pay, yes, for the assets which are located in Italy. So this is the first big difference.
Okay.
We come later back to this issue because with the flat regime of the taxation 200K, there is also a big benefit about that, about inheritance tax. But generally speaking, I say that it's quite convenient because the taxation rates are really very low. We have 4% of inheritance tax if the inheritance goes to the wife or to the kids, 6% to siblings basically, and in all other cases 8%. And
Okay.
you on top you have also free amounts. That's to say the wife and each kid has an amount which is free of inheritance tax up to 1 million euros, roughly
Wow.
$1 million now. Yes. And in case of siblings, it's just 100,000 K. But in any case, it's quite interesting. And how do you have to pay it? Basically, you become a payment notice coming from the tax authorities. You have to do an inheritance return where you have to fill in all the assets which are under the inheritance tax. And also very important to mention is that on real estate, you have to pay a supplementary tax, which is linked to the fact that they are in public registers. So we have a mortgage tax, we have a cadastral tax, which are in some 3%. But the taxable base is very low because either for this cadastral and mortgage tax, either for the inheritance tax itself, real estate, the taxable base is not the fair market value, but it's a lump sum value, which is calculated on, it's calculated on a cadastral value. So it's really a lump sum value, which is normally far below the market value.
Okay, very cool. And so before assets transfer in an inheritance, do you have to file and pay the inheritance tax and some of these other things? And then once that they're paid, they can transfer over, or does the transfer happen and then you can pay it?
No, you have first to submit this inheritance return. You have this kind of declaration, and once you file it, then you got the payment basically, which is coming from the tax authorities themselves. And also with this tax return, or better with this inheritance return, you can go to the bank, for example, to get the investments you inherited and so on. So this is something you have to do first in order to get the benefits of the properties and the money you will earn.
And if I can't pay the taxes in full, can you pay it on a payment plan or in installments, or is there like a
no, basically you have to buy it in full, I guess.
Okay.
I don't remember if you can pay it in installments, but normally you have to pay it in full directly.
Okay, got
Yeah.
it. All right, let's switch gears a little bit to business tax planning. It's from my experience of work, I spent a lot of time working in Switzerland. A lot of times when we see folks that are entrepreneurs or people that want to operate businesses, you come into Europe, you create a business entity, and then you kind of do it that way. Is that kind of give our audience a little bit just of a general 50,000 foot overview? What types of business entities are available in Italy? Say for small business entrepreneurs all the way up to the big boys. And are they desirable to do? I mean, in the United States, I tell a lot of people, you don't necessarily need a limited liability company. You can operate as a sole proprietor. Sometimes it creates more hassle than it's worth to create a business entity.
Well, it depends, as you say, basically on the size of business, let me say, because in Italy we have, as I guess everywhere, we have stock companies and we have partnerships, okay? And clearly the difference is that the partnerships are quite easier maybe to manage, but you have a full responsibility, let's say in general terms. While if you have a joint stock company or limited liability company, you benefit from the fact that the responsibility is just related to, let me say, the share capital and to the net equity which the company has, unless clearly an individual who is shareholder signs some guarantees or so on. And clearly, if you want, let me say, to keep the business safe and not to take too much risks, you should opt from the risky point of view from share capital. From the taxation point of view, there are no big differences. I mean, the stock company pays corporate taxes in Italy. We have two kind of taxes, corporate taxes, which are 24% and the regional tax 3.9%. A partnership, so roughly 28% in sum. A partnership pays this regional tax directly, and the taxable income then is directly, as it's being transparent, it's attributed to the shareholders, and then they pay the income they get from the partnership basing on the taxation brackets we have in Italy for individuals, which now have changed, and they are honestly these are high, because over 50,000 euros now you pay 43%.
Okay, got it. So my first comment on the corporate tax is that in the United States, we have a controlled foreign corporation regime that institutes a quote unquote guilty tax, which just tells you what Congress thinks about US people that have foreign companies, that they have a guilty tax. But we have a guilty high tax kickout or exemption, which means that if the foreign corporate tax is greater than 90% of our US corporate tax, which is currently 21%, so 90%, 18.9, then no guilty tax is applicable. What's really interesting is that we have a proposal in our Congress for our new tax law that would drive our corporate tax rate from 21% down to 15%. So I think the guilty high tax exemption would apply basically to a lot of countries, except maybe not Ireland or some of those places, or the zero tax places. And then your pass-through sounds exactly like kind of how our pass-through works, and seems like they would match up very well. Let's go back for a second, because I always want to make sure I'm respectful. This is my 22nd tax season that I'm coming into, and I always tell people, be real careful about how many questions you ask and how much pressure you put on the tax teams during their busy periods. The running joke is that, we get to Valentine's Day and I take my wife out for dinner and I say, okay, I'll see you on April 16th. The next 2 months, I'm basically super busy.
I'm not available. Yeah.
I'm not available. Yeah. Don't poke the bear. Don't feed the wild animals. What are the critical due? We talked a little bit about the tax filing season in Italy. You mentioned that the due date's October 31st and the payment date's in June. But talk to me about, what are the busy periods in Italy? Like, when are you guys super busy? What are any specific critical due dates that the audience needs to be aware of?
Till, I would say, 20 years ago, everyone would have told you May, but now it has changed in the last year. So I would say the only month where we are not that much busy is November and December, because the other months, if you have either corporations, either individuals, every month you have to do something. So, for example, for us, January and February are busy because we're working with multinational groups. They have to do the packages, the consolidation, and they want already the taxes. Then in March, April, you have the financial statements to close. In June, you have to do the balance and the first installment for the tax payments for everyone. July and August more or less. It's a season of a summer season, but then September, October again you are under pressure for the tax returns. So I would change it and say not that much under pressure is just November and December.
Got it.
Right,
And
Paolo?
yeah, go ahead.
I
Sorry.
agree.
Paolo, please.
No, yeah, it's
No, go ahead. Go ahead.
like that.
Got it. So just so the audience is aware, and I learned this I spent a lot of years working in Switzerland.
Mm-hmm.
One comment that you made there was July, August being the summer season. And I just want to make sure everyone understands, for those Americans that don't really understand Europe, like July, August, it's very hot there. People take time off. They take a lot of vacation during those months. I always tell people, if you don't really get your answer by, like, say, June 30th or maybe the 4th of July here in the US, maybe don't expect that answer to occur until early September, because the Europeans, that's when they take a lot of their time off. They enjoy that time. I wish we had that here in the United States, because we do have similar type of weather periods that occur during that time period. But just so everyone is aware, you have that June, July, August period that's normally occurs in Europe. And then I think what Dirk was saying is, look, November, December, that's probably a time period where they probably are, taking off and not having a busy time.
Just to add that, consider that August is traditionally the holiday month in Italy for everyone, and it comes from a long-lasting tradition, because we had all the big plants like Fiat and so on, which used to close the plants for 1 month. And so we are living, let me say, with that tradition, and until now, more or less every business closes in August. So it's honestly, it's impossible to get answers or to do business during August. It starts the end of July, and it starts again the beginning of September. In August, more or less nothing. No one is working.
Yeah. And, I learned that the hard way. In the United States, we have a pass-through business entity extension deadline for September 15th. And I learned the hard way, like, if we didn't get the stuff by, like I said, June 30th, then we're pulling out our hair, because we probably were not going to get back in contact with people until September 2nd, 3rd. And that can be a real big problem. Let's switch to a taboo topic. So in the United States, I always tell people the United States government is very nosy. And while we do care about income tax, we really like information. We put a premium on information. And so in the United States, we have certain rules where we like to know everything about everything about everything. So we want to know about everyone's foreign bank accounts, all their foreign pensions, all their foreign brokerage accounts, all their foreign trusts. And generally speaking, across the world, this is known as the disclosure of foreign financial assets. And other countries have their rules where they require, to disclose foreign financial assets. So, a lot of times I'll have my clients living in Italy, and they'll say, well, we've got to disclose all of our US bank accounts and all this other stuff. And, I kind of get the drill, because I asked for it for the non-US side. Tell us, does Italy require tax residents to disclose foreign financial assets? And if so, is that a burdensome process? Are there penalties for non-disclosure? Walk us through how that works.
Yes, for sure. We have to disclosure duty, because Italian tax residents has to disclose. There is a specific form in the tax returns called RW form, where you have to indicate and expose which are your foreign assets. And so financial assets, properties, valuables in general, every asset from which you can receive an income, in general, as a general rule, substantially indicating the value of these assets. And so, yes, there is a similar disclosure duty also in Italy, yes, for sure. And also because there are two wealth taxes connected to this duty, because there is a real estate wealth tax on foreign properties, 1.06%, and a 0.2% tax on financial investments abroad, of course. And so, then Dirk would say the flat tax regime could avoid this problem, these taxes, and also the disclosure duty. And but yes, ordinary outside that kind of regime, ordinary Italian tax residents has to make disclosure of their foreign assets. Yes.
And if they don't do it, is there a big penalty?
Yes. Well, yes, it's 3% of the value of
Oh,
the assets you have not declared. So it's quite a relevant penalty.
yes.
Yes. So you have to pay really attention to what you declare, and also to indicate proper values, because the penalty is relevant for sure. If
Wow.
big figures, 3% could be a really big penalty.
Yeah, no, it can be large. Whereas in the United States, it's just we love our $10,000 penalties. That's just it's like every other form. It's a $10,000 penalty. This $10,000 penalty. That.
No, in this
Um,
case,
It's flat.
It's flat. Yeah, that's good.
Yeah.
no.
Okay. Or can be bad, like you said, in some situations. Let's talk about what I think everyone listening to this podcast is probably looking to talk about this next topic, which is, and I think Dirk, you referred to this as the 200K.
Yeah.
But let's talk about the flat tax regime. So going inbound into Italy, there's a way to get in. There's this flat tax regime. And when I heard about this, I heard Dirk talking about this at a conference last year, and he did a great job kind of going through it. And I was like, gosh, we've got to figure a way to get this on the podcast. I think I've heard about this for many years now. I think it came into being, what was it, 2017 or maybe even earlier? I don't know.
Yeah, more or less 5-6 years now, I guess.
Yeah. So 5 or 6 years it's been there, and there's been some changes recently. So talk to us about the flat tax regime. Give us all the details.
Yeah.
What does one have to do to get into it? Once you're into it, then what do you got to do, and then how do you get out of it?
Yeah. So basically, it's a regime which should attract high net worth individuals. This is the idea, to attract, let's say, rich people to Italy. And the taxation system which is offered in this case is really really, you have to evaluate it, because the benefits are high. But basically, the idea is that if a foreign individual comes and transfers his residency to Italy and chooses, so makes an option for this regime, there is just one income tax to be paid once a year, which is a flat tax of 200,000 euros. It was hired up to 200 because till last year it was 100K per person. And you have to pay it once a year, so 200 per year. But the biggest advantage is that becoming a tax resident in Italy, you don't have either to give any kind of disclosure about any kind of investment or assets you have abroad, and either, and this is the most important thing, you don't tax your worldwide income. So Italy just wants to get 200K from each individual, and then you are free from any kind of different taxation. We have some exceptions, maybe we can go in, but basically the general rules about the regime is this flat taxation, which then cancels any other kind of income tax you should pay if you are an ordinary normal resident in Italy. And this regime can be extended also to the family, let me say to the family members, with a very few amount, because it can be extended to kids, to the wife, to the spouse, for 25,000 euros a year per member of the family. Yeah. So let me say the father or the person who applies for this regime, the principal has to pay 200, and the others, and it's optional also for them, 25,000. This regime lasts for 15 years. Then you can't renew it once, but you can step out during the 15 years. And one of the big benefits also, as also Paolo addressed before, is that when you submit your tax return, which basically is limited to each year checking the box of this flat regime, you don't have to give disclosure of any other kind of investment you have abroad. So neither to give disclosure nor to pay this wealth tax on real estate or on investments you have abroad. I want to add that two important exceptions you also can choose to do is that you can also, if you are interested, it depends on the individual tax planning you have to do. You can do a certain kind of cherry picking, because you may also decide not to extend it to all the world income, but you can choose, for example, that one state will not benefit of this regime. So you have then tax 200K, which is the base, and then you will tax ordinary all the income coming from a certain state, which might be the United States, Thailand, whatever you want. You can choose to do that. Otherwise, all in, and you are fully covered with the 200Ks.
Okay, so what I heard is if I'm Jeff Bezos from Amazon, and I'm getting a lot of income every year, I'm getting billions of dollars of income, I can go to Italy and I can say, you're not going to tax me on my billions of dollars. I'm simply just going to pay you the 200K each year. I don't have to disclose my ownership interest in Amazon.
Yeah.
Is there anything, you talked about some exceptions though, and maybe you already mentioned them, but is there
one important thing to mention is that basically all the also capital gains are clearly exempted on participations, with the exception of what in Italy we call qualified participations, which means basically, as a general rule, 20% if you have 20% or more of voting rights in a company, or 2% if it's stocks listed. If you have this kind of participations, you have for the first 5 years to report them in any case in the tax return, because in the first 5 years you live in Italy after having done the choice, you can't benefit of the exemption. So if you would sell the participations in this 5-year period, you have to pay for that. So the capital gains on this kind of participations higher than 20% are then free starting the 6th year onwards. Okay.
So if I'm Jeff Bezos, I don't want to sell my stock in Amazon until you're 6 years set, basically. Just
enjoy 5 years in Italy and then decide whenever you wanted to sell something.
Okay. And so I heard you say that you still have to file a tax return, but you're just checking a box. And so is that due by October 31st, same as everybody else?
Yeah, you have to do that, and the option, I just want to mention that the option has to be done in 2 different ways. Either you submit a ruling to a central tax authority before you come to Italy or while you are already in Italy, or you can also not submit the ruling, but you have to then give all the disclosure and the informations in the tax return. One of the preconditions I didn't mention before, but I tell you now, is that you have not to have been a resident of Italy in the last 9 years out of 10. So this is, they won't be sure that you had no, let me say, fiscal ties to Italy in the foregoing 9 years out of 10. Okay. And then there are some conditions you have to meet. Basically, let's call it a kind of checklist, and you can decide either you do it directly in the tax return, but we never suggest to do that, because I prefer to be sure that you can benefit from the regime before. That's why the cases we have in our firm, we all decided to submit the tax ruling before. Also in this case, let me say, there's a kind of checklist. You have to give disclosure of all the indications. They also want to know which ties you had with Italy before, maybe if you have real estate, if you have participations and so on, because they want, the tax authorities want to clarify if you actually have never been or can't be considered as a tax resident. So let me say, if you have just a house and you came over once for holiday, this won't be something, this won't be an obstacle. Otherwise, maybe if you have a center of interest in Italy because you have a lot of real estate, a lot of participations, you have already your family here, it could be that they say, no, sorry, you can't be admitted. But honestly, the cases we have had up to now have all got the chance to benefit from it.
Okay. And so I'm a big fan of advanced rulings. I agree with you. I want to know for certain before I advise a client to go do something or, get into a regime. How long does it take? So I come to you today and I say, look, I want to do the 200K. I want to come inbound into Italy in 2026. How long does it take to do the advanced ruling? Like, how much lead time do you need?
Basically, they have 90 days to respond. It's frequent that they ask for some more information. So let's say basically collecting the information and then getting the response, even if they ask you for something more, it's between 4 and 6 months, more or less. Consider this as a reasonable time frame.
Okay. And do I need to physically be in Italy to respond to stuff? Or if I'm going with you, are you going to do it for me? Is that okay?
Yeah, for sure. If you give a mandate to a professional like we are, we do all this stuff for you. Clearly, we have to exchange all the informations with the client before. We need
Right.
a complete disclosure of the real situation. Then we see what's the checklist. We address the ruling to the competent authorities, and then we wait until we get no response within the 90 days, or the most of times, normally they want to see something more. And then you get the let me say, the response that you are admitted to do that. Okay.
Okay.
And
then, yeah, go ahead.
one important thing also to add is also the time frame when you can choose to the 200k flat regime is quite restricted anyhow, because you can do it either the year you come to Italy. So basically, if you come till the end of June, so you become a resident for 2025, you can decide to benefit from that or in 2025, or at least, but this is the second and last option, the year after you move to Italy, so 26.
Okay.
So in the year you come and in the year after that you have lost the chance to benefit from that. So you have to consider that you have basically 2 years to decide.
Okay, so it sounds like timing is key.
Yeah.
My last question about the advanced ruling, just for the US folks that are listening here, is there anything that's going to be needed from the US tax practitioners to help assist with putting together the advanced ruling? Like, do you need us to provide a letter about their tax situation or copies of tax returns?
No, basically what it's requested sometimes is, it's not foreseen by the law, but it's frequently requested by tax authorities. They want to prove the actual tax residence you disclose in the ruling, because you have to say, in the last 5 years and the last 10 years I was a resident of the USA. So maybe they ask you to get some indications about that. So if you have tax returns, if you have electricity bills, if you have, I don't know, the contracts for the apartment, for the flat, the house, and so on, all the things which go in the direction to prove that effectively you were a resident abroad. And for sure, this is something we can use. And clearly, the interaction with the professionals on the other side of the pond is clearly very close. If we have to understand, are there, for example, some states you want to exclude or not from this choice? Yeah.
Okay. I will say for the US folks that are listening, there's also a way to request a tax residency certificate from the IRS. It's what's called a 6166 letter. I can tell you though that it's a nightmare for processing time. So if you're going to try to get that letter, there's a special form you got to fill out and a fee you have to pay. But give yourself ample time if you're trying to get, if you're trying to go outside of the stuff that Dirk was talking about there. Okay, let's talk about what I think is the most important part. Do we all feel like, and I think I know my answer to this from the US side, but you guys tell me what you think on your side. If I pay the 200K, is that a creditable tax for foreign tax credit purposes in other countries? Like, would I be able to take, if I'm in the US, right? Can I take that? And maybe you can't answer that because you're not a US tax practitioner, but I firmly believe that yes, you can. You can take the 200,000 that you pay in the flat tax, and you can use that as a credit against your federal tax due.
Honestly, I don't know. I don't know, because I mean, you have to look at the tax regime of origin. In Italy, it's considered a substitute tax, because it substitutes the ordinary income tax. And normally, on a substitute tax, if it would be the other way around, you would not credit it. If it would be from in a foreign substitute tax, we have, for example, this issue on all the withholdings on capital investments abroad, if they are considered substitute tax or not. But maybe Paolo can be a little bit more precise on that, maybe.
So Paolo, do you want to tell us your thoughts on the foreign tax credit? And then also, Paolo, I want to understand, can someone under the 200K regime take advantage of the tax treaty? Is that allowed? Do we think that's allowed?
Well, on the second question, also the tax authorities, obviously from an Italian point of view, they clarified that according to us, even if the taxation is made on a lump sum basis, so it's a flat tax, the individual is considered as an Italian resident. And so under an Italian point of view, they can apply double tax treaties.
Okay.
The tax authority has clarified this also officially, so it's quite a sure position. The other one, yes, as Dirk said, of course, it's a problem more from a US side, in a sense, if the US authorities accept or not. In our case, it depends on the cases, of course, but could be a limitation. But if you have paid the taxes finally, you can use them maybe with a limitation in quantity, for example, but they are at least paid taxes. It's the payment is final, then is an amount. You cannot, if you have a subsidy tax in Italy, then the foreign taxes cannot be credited because it's a particular way of taxation, but the foreign ones, if final, can be credited in Italy. So I don't know if US is the same. So in that case, also our flat tax can be considered in US. If I understood, it's your position.
Yeah, no. So I think there's a couple things to note here on the US side. The first off is that if the 200K is paid in the following calendar year, then from the US side, you need to change your method of accounting for foreign tax credit purposes from paid to accrued. So you have to be real careful about the timing of when the tax is paid in Europe versus taking the credit on the US side. The second thing is that for all US tax treaties, we have a savings clause, which basically, if you read it very closely, it says if you're like a US citizen or a green card holder, you have to act as if the treaty doesn't exist, subject to certain exceptions. So there's a limitation on what you can actually use in the tax treaties for those folks. But one important clause is that there's a double tax treaty clause in all U.S. tax treaties where you have the ability to resource U.S. source income to make it foreign source so that you can get a foreign tax credit. And I think here for this exercise, that's where I would tell a lot of tax practitioners, U.S. tax practitioners, if you're going to do an analysis to see if the 200K can be taken as a credit, first you're going to have to resource the income to make it foreign source. Then if you think you can take the credit, then you'll be allowed to do it. So this is where I think having a good working knowledge of the U.S.-Italy tax treaty on the U.S. side helps you out a ton. And that's where I think the battle is won at. Let's switch gears for just 2 seconds, because when I was talking to you guys in our pre-meeting, you brought up two other ways to kind of come into Italy that you thought the audience should be aware of. So we've been talking about the 200K regime. Tell me about these other two regimes that we talked about. I think there was an impatriate regime, and then there's a pension regime. Let's go through those so people can understand what some other options are.
Yes, there are these other two regimes can be interesting. Maybe I talk briefly about the pension, the foreign pension, because it's more similar in a certain way to the flat tax, in the sense that even in this case there is a substitute tax. So on foreign, if the individual has a foreign pension, then it can apply on an optional basis for this regime and apply a 7% substitutive tax on all his foreign income. Is taxed ordinarily on Italian source income, but it can apply this reduced taxation on foreign income. The conditions are the fact to have been tax resident abroad for 5 years, so similar to the other one, but a shorter period, to have a foreign pension. And the other condition, which is important, is to transfer in Italy, but only in towns in the southern part of Italy, in towns that have less than 20,000 inhabitants. So in little towns in the southern part of Italy. This is the condition. But it's really interesting because you have this 7% substitute tax, not only on the pension, the foreign pension, but on all foreign source income. So it's quite interesting. The other regime, which is for inward expatriates, is in a certain way, the logic is the opposite, because you then have an advantage on foreign income, because on foreign income you are ordinarily taxed, but you have a benefit on your employment and self-employment income of Italian source. In this case, you have a 50% exemption. So you pay ordinary tax, but only on the 50%, so half of your wage over your compensation as a self-employee. And the conditions in this case are stricter in a certain way, because you don't have only to transfer to Italy, but you have also to commit to remain in Italy for at least 4 years. And then, even in this case, you have to demonstrate that you have not been a tax resident in Italy from 3 to 6 years. It depends on the situation, on the employer. It's a new employer, the same employer you had abroad, and so on. And the other two conditions which are very important. One is that you must be a highly skilled or specialized worker. It is a new condition. Till a couple of years ago, everyone could apply this kind of regime. Now you have to be graduated with certain kind of matters and so on. And the other one, which is very important, is that you have to carry out your activity as an employee or as self-employed mainly in Italy. So the logic is the opposite of the flat tax of the pensions regimes. In those cases, you have a benefit on the foreign income. In this case, the benefit is connected to the activity carried out in Italy as an employee, so employment income and self-employment income from an Italian source. In that case, you have a big advantage because, as Dirk told, you have an ordinary rate of 43% over the 50,000 euros. In this case, up to 600,000 euros, you pay only on half of your wages. So for high skill consultant, high skill employee coming to work in Italy for big companies, it can be a big advantage.
That's awesome. Yeah, that's great. And I think in the past, when you were talking about the pensions, we have, and we don't need to go into it on this right now, but I just want to make the comment. I think we have referred to you guys, and you guys have looked at the World Bank pensions and some of the international organization stuff. So for those folks that are with the World Bank, IMF, those international organizations, if you need an analysis on that, come talk to Dirk and Paolo. They can kind of walk you through that. Briefly, let's talk about the KYC rule, know your client. Because I think it surprises a lot of my US clients when I send them over to deal with, whether it's UK or European, there's a bunch of stuff that they have to provide to prove who they are. Whereas in the US, we don't really, people send me their passports all the time. I'm like, I don't really need this because we don't have KYC at least not yet. Talk to me about the KYC rules, just so people can understand the method of.
Yeah, it's very. Sorry, it's very strict because it comes from a European directive, so it has been implemented in all Europe, in all the European countries, in Italy as well. And it means that you have to identify who your clients are. Which means basically you have to understand where they come from, etc. And especially if they are doing some kind of investments, classically, if they open a company in Italy, or if you make an M&A and a foreign company is buying a participation in Italy or a company in Italy, you have to identify not only the company which is buying or the individual who comes over to Italy, but if it's a group structure, they want to know who is the final beneficial owner. And beneficial owner, just to be, let me say, very simple and very clear, means if there is an individual who has more than 25% of the shares, of the ultimate shares, and you have to identify this person to give a disclosure of this person. And this duty is upon consultants, upon the banks, upon, let me say, everyone who gets in touch and gets a mandate from a foreign person. So if you want to open a bank account as an individual, you will be, let me say, you will be under these rules. If you get in touch with a notary, with a tax advisor, with a lawyer, with an attorney, everyone has to do the same stuff. And on top, we have also the implementation of a rule which now foresees that this information has to be deposited at the Chamber of Commerce. There is a special, let me say, the department or unit, as you may call it, where this information has to be deposited.
Okay, great. I just want to make a couple quick comments. We're going to shift gears here to a couple quick comments I want to make on the U.S. side for Italians coming inbound into the U.S. And I just want to reiterate what I said earlier, which is the United States government, and specifically the Internal Revenue Service and the departments of the Treasury, have very strict reporting requirements when it comes to foreign bank accounts, foreign brokerage accounts, all that stuff. I just want to make one quick comment about folks specifically from Italy, which is that the United States a long time ago had lobbying where we have certain rules put in place where we don't like it when U.S. people, so if you're coming inbound to the U.S., you're going to be considered a U.S. tax resident. We have very strict rules that make it very punitive from a tax perspective to own foreign mutual funds, foreign ETFs. So when I see a lot of investment portfolios from people from Italy inbound into the United States, they're normally in violation of our US, what we call PFIC rules, PFIC. It's a very punitive tax regime. And so literally, if someone's coming inbound from Italy into the United States, what I really like to do, I first try to tackle, like, do we have any PFIC issues? Are there any investment portfolios? And then I like to just talk about basic broad foreign financial asset reporting under FATCA and the FBAR. For those that want to learn more about that, I do have a podcast where I previously talked about FATCA and the reporting of foreign financial institutions inbound into the United States. I'll link that in the show notes. I'll also link some articles we have on the US PFIC regime if anyone's interested in learning about that. But my advice is always clean that stuff up before you come inbound into the United States, because if you don't, it's going to create havoc on your US tax return and then it explodes. Okay, let's talk about a more interesting topic, which are US folks inbound into Italy. And I really only have one question here, which is I have a lot of clients that have ownership interest in what we call an S corporation, or in some cases partnerships. One of the big problems we always have for example, going into Spain. I know, for example, Spain hates the S corp, so we always have to get rid of the S corp and we have to convert it to a C corp. But tell me, if I'm telling someone going inbound into Italy and they have, a U.S. business like a S corp or a partnership, is Italy going to respect that? Is it going to have the same pass-through tax? Because those are pass-through transparent entities. How does that work?
No, as Dirk told, we have also in Italy, from an internal point of view, pass-through entities. But the strange thing is the sense that the tax law is different for foreign companies, because regardless they are opaque entities or pass-through entities, from an Italian point of view, all foreign companies are opaque entities. So the Italian resident shareholder or stakeholder of the company, in any case, is treated as he has a C corporation in the end. So he's taxed only on the profits he receives as they were dividend. No difference between pass-through entities or opaque entities. All foreign companies are opaque entities. We are talking about some changes in the tax rules that could lead to recognize the pass-through regime, the foreign pass-through regimes, because even other countries have this kind of regimes. But at present, it's not so. At present, you have tax as an Italian resident only when you receive profits from the foreign company, even if it is a pass-through entity.
Okay, so similar type of issues then. So something
then it gives also origin to some problems, for example, with regard to the tax credit in Italy then, because of course there is a problem. You have been taxed there as pass-through regime, and then you receive something which is not dividend, but is treated as dividend from a tax point of view, and it's quite critical. But as the principle, the principle is that, unfortunately.
Okay, got it. All right, last big question. I know that there was a budget law just signed into effect in Italy at the end of December. Any big changes that the audience should be aware of? Any other items that you think need to be mentioned here at the end?
Well, we say no, in the sense that there have been a lot of changes, but I would call them operational changes, in the sense changes in detraction, deduction, fringe benefits. So a lot of operational issues regarding even individuals, but nothing that has an impact on the main principles and also on the regime we have talked about. They have been changed couple of years ago with effect to 2024, as they say that the change from 100,000 to 200,000, or as I said, the changes in the expatriate regime with stricter conditions, but not ruled by the new budget law, and they are in force, or they were in force already in 2024. So nothing new with regard to what we have told during our chat.
Okay, so business as usual in Italy. So just to conclude here, it's been my experience anytime I refer folks over to you guys are very responsive. But if people want to get in touch with you in general, they want to talk to you, maybe they want to get a consultation on the 200K regime, or they need help doing their Italian taxes. How does that work? How can people get in touch with you? Will you guys send us some links for the show notes so people can easily access and figure out how to get to you?
It's very easy. We have our website, which is hager-partners.it, and maybe you can share also our emails, mine and that of Paolo, and we will be happy to get in touch with everyone.
Okay, fantastic. Well, look, Dirk, Paolo, thank you so much. It's been eye-opening. I always learn a lot when I do these podcasts. We're talking about cross-border tax issues. You guys have been fantastic, and we would love to have you come back at some point in time and give us an update should something significant change in Italy.
We will be happy, and thank you to you, Mishkin. It was a pleasure.
Thank you very much. It was a pleasure.
Thank you.
Rock and roll.
Yeah. Bye. Bye-bye.
Bye.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.